Hey crypto traders. This lesson will be over the fundamentals of risk analysis. My name is Stefan and I'm one of the lead analysts here at cryptotraders.com. Hopefully during this lesson you will learn some of the fundamentals of a trade and be able to control your risk, your exposure, and overall protect your reward. So let's go ahead and get started. To start off, we're going to be going over some basic definitions. So risk, reward, and exposure, and how they all correlate, leverage, stop loss, and take profit. So risk is the percentage you're exposing to the market correlating to the reward to make it worth the trade. And then reward is the predetermined amount in correlation to risk to make it worth the entry. And then protecting your money is more important for long-term success than gaining. So understanding this concept when figuring out your risk and reward for any trade is very important. Exposure is the amount of money invested in a single trade, so the total amount of money you're exposing to the market, period. So if you're exposing $100 and you only plan on risking 5%, so that would be $5, you're still actually exposing $100 when you enter the trade. Until you close that trade, you have $100 exposed. Regardless of what your risk and reward and your plan is, exposing is the amount of money that is exposed to the trade. Leverage is a tool used to manage your exposure and risk, and it's not a get-rich-quick scheme. I repeat that again, it is not a get-rich-quick scheme. Yes, you can make profits quickly, but the real reason for it is a tool. It can be used, and you want to use it to to control the amount of money you're exposing and to manage your risk in trades. So as an example, you can do a lower risk trade with low leverage or no leverage, and then a higher risk trade with higher leverage but way smaller amounts of money, so that you can make more money but only expose and risk less amounts. So stop loss is the point at which your trade is invalidated. Also where your risk is defined. So wherever, if you say you only want to lose 5%, so that's where your stop loss would be at the point of 5% loss. But this definition means that, like, if my bias is I want it to go long and I'm entering a long position, and let's say it's going the wrong direction, if I know that once it crosses this point it's going to continue in that wrong direction, then I know that that point is a good place to place the stop loss. So it's the point at which your trade is invalidated. That makes sense. And then take profit is the point where you exit the trade to de-risk and decrease your exposure. So that actually goes back to protecting your money is more important for long-term success than gaining, because what this means is you're actually de-risking and decreasing your exposure. So you're taking out money out of the market, so your exposure is decreasing, and then you're de-risking by, let's say you have scale take profit points. So let's say you take 20% out. By doing that, you're actually de-risking and decreasing your exposure. So that's really what's important to understand when taking profit. It's not about making money. It's more about protecting your money. The next section we're going to be talking about is the fundamentals of entering a trade. And when you're entering a trade, there's three main areas of importance. So you have the entry, the trading plan, and the management of the trade. All three of these areas are overall equal, about 33.3% each. And in each area, you can actually self-grade and self-evaluate to improve. And you can figure out, mistakes, and you can become more efficient in these areas. So to dive in deeper to these areas, we'll look at them here. So the first thing we'll talk about is the entry. The entry is finding any opportunity in any asset class. So just you do some research and you find out that this is something good to look into. So now at that price point that it's at. So now that you've done that, the next step that you actually have to do first is establish a trading plan before you actually put money into the trade. So like this says here, this stage happens first, but before you enter the trade, an established trading plan happens before the actual entry into the market. So the trading plan breaks into three basic things: the entry, the stop loss, and the take profit. So the entry is the price at which an investor buys or sells a cryptocurrency, also a component of a predetermined trading plan, trading strategy, like we were talking about here. And then stop loss, like we talked about in the definition categories, the point at which your trade is invalidated, ideally following the golden rule, which we're going to talk about later on in this video. And then take profit, the point at which your take profit decreases your risk and you're protecting your profits. So establishing this trading plan with the levels and everything that you want to follow, then once this trading plan is established, then you can actually enter the trade. But even just finding a great opportunity actually has a lot of value in itself. So that's why this has its own 33.3% section. And then creating the trading plan is also equally a section. And then finally, the management of the trade. With management of the trade, you have a few things to note. First, following the trading plan as closely as possible helps remove emotion from trading decisions. And then small adjustments can be made depending on the situation based off of logic, not emotion. So basically this means making decisions based off of your trading plan and not how you feel in the moment. Now, some of the small adjustments you could make, so it could be such as maybe moving your take profit points slightly, or making decisions based off of new information that maybe wasn't there when you were creating the trading plan. But notice how it says small, because the more you can follow the trading plan, the better, because then after the trade is completed, it helps you look back and you can see where in your trading plan you can make you can change up certain things, and you can figure out where your mistakes, and you can improve upon those mistakes. And then finally, you almost always want to take a stop loss and move on to another trade, because protecting your money is more important than gaining. Again, this is repeated, it's very important. So if you enter a trade in an asset and you want to, let's say you still believe in it and you really still think it's going to go the direction you want, it's actually better to just take your stop loss, reevaluate where you want to re-enter, and then make another trade. Because everyone's going to be wrong, and you need to understand that being wrong is okay, and just move on from it, and then maybe on your next entry you can be right. The next section we're going to be talking about is exposure levels. And then again, this saying protecting capital is more important than making capital is exactly what this is about. And so you have three categories: low risk, medium risk, and high risk. And each one has correlating amounts of capital and the amount of leverage you can use, and then the time frames and the amounts that you want to take in those time frames. All of these are just maybe not all like the most efficient, but it's just like a good fundamental baseline to start from, and it's important to understand these three categories. So with low risk trades, you want to use 60% of your available capital. You want to use little to no leverage. Normally, time frame wise, these can be some more of your like long-term trades, maybe even investments. And you on average want to take 2 to 3 trades intra-weekly to monthly, meaning 6 weeks to even 6 months. You only want to take 2 or 3 trades, and you just want to do really low risk. Don't really ever expose a lot amounts of your money. Whenever it starts to go the way that you want with no leverage, it can take a month for your levels to hit. If not, you still want to have like potentially scaled take profit points and de-risk, etc. And then with the medium risk, you want to use 30% of your capital. And then now with this section, you can actually do a little leverage, and you can make your decisions what you want to do on how much leverage. I wouldn't recommend with this amount of your capital exposure wise going over 10x ever, because it's basically, if you go over 10x, you're really entering into the high risk category. Some would even argue over 5 to 7x is already high risk. And then normally the time frame for this medium risk would be intra-weekly to daily. So meaning like every 10 days to maybe 6 weeks. So within that time period, you want to make 2 to 3 trades. So, and this is just like the minimums, and it doesn't have to necessarily be just 2 or 3 trades. You can take a lot more than that. You could take 10 trades if you wanted, but you can just shoot for 2 to 3 if you're really just shooting for really great entries, and just positive trades. And then finally, the last category is high risk. And then with high risk, you're going to do 10% of your available capital. And then you could do 5x to 30x. And 30x, you never really want to go above 30x. Now, some people, they do like, they'll expose like 1/10 of 1% or, 1/50th of 1%, and they might do a 100x trade. That's pure gambling, because at 30x, if it goes, that means it has to only go 3%, basically 3.3% in the wrong direction for you to get liquidated. So basically anything over 30x is like, you're basically saying that if it goes any way in the wrong direction, you could potentially get liquidated. So that's why it's a high risk. I would recommend 15x as the highest, because that means that you're a little over 6%, and so you have some room, and you can actually make some really nice gains with this. When with 15x, let's say you had $100, you're actually trading on $1,500. So you're controlling your exposure by doing a less amount. And normally, time frame wise, with trades with this amount, you can take 2 to 3 trades hourly to daily. So every 24 hours to like 10 days. And again, this is just like a minimum. Basically, the reason why I put these minimums here and these just like the amounts that you kind of want to shoot for is sometimes people overtrade, and they just, like, let's say they have a good trade and they make some good money. Like, okay, now I want to make more money. And then they enter another trade too quickly. So sometimes it's better to just, it's okay if you miss some opportunities. It's better to just, slow play and make your money over time, and just always never feel that, don't ever enter a trade, especially at a point of elation, because that's when emotion gets involved. So you really want to try to always base your entries and, the trades that you take based off of logic and information. In this section, we're going to be talking about the golden rule. So basically what it means is when opening trades and establishing a trading plan, ideally basing your risk on 1% of your total portfolio is ideal. This is what they teach you when you go to like trading school, or when you learn it in a lot of books. They talk about this, the golden rule, because basically what it means is if you only risk 1% per trade, you can be wrong 100 times before losing everything. So it basically, like, it's a way to controlling how much you expose to the market every single time. And then if you get one right, let's say on one right trade you make 10%, and then you have 10 bad trades, then it kind of evens out, right? So exactly here. So for example, if you have 10 trades that hit the stop loss with 1% each time, you lost 10%. If you have one successful trade with that 90% and you get 10% profit, you will be at 99%, meaning one profitable trade basically counteracts 10 unprofitable trades. You can be a very successful trader only being right 40% of the time, and even less if you follow this golden rule on risk. I think that the golden rule is a great start point if you're a beginner trader, but once you've done it a lot and you've learned and you kind of know how to manage your risk, I do think that it's okay to go a little bit over this 1% rule, but that's just me personally. I think between 3 and 5% would be the max that you would ever want to do. Over 5%, now you're entering into an area where you're exposing way too much money, potentially. So that's the golden rule. So finally, to wrap up the lesson, just a few important things to note. Again, protecting your money is more important than gaining money with trading and investing. To be a successful long-term trader, meaning doing it for 10 years, 20 years, and looking for your long-term success. And then try your best to make all decisions based off logic and not emotion. If you find yourself in an emotional position, the best thing you can do is protect your money and reevaluate with logic in the future. Following your trading plan is always what you want to do. And then always learn from your mistakes. And if you find a reoccurring mistake, find creative ways to cut the mistakes out and make more efficient decisions in the future.